ServiceNow reported quarterly financial results after the markets closed on Wednesday, October 23rd. The results have sent the stock price down by roughly 2% in the aftermarket hours following the release. In this video, I'll review a little bit about what ServiceNow does, the business model, and then I'll go into detail about their latest quarterly financial results. And finally, I'll update my buy recommendation for ServiceNow stock. I've had this stock rated as a buy all year long in 2024, and I'll let you know after the video, at the end of the video, if I'm keeping it there or if I'm bringing it down a notch or what I'm doing with ServiceNow stock after these financial results. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. And so let's try and get an understanding of what ServiceNow does. And partly, they start with technology workflows and they accelerate the digital transformation with resilient, cost-efficient, and secure technology. They drive employee productivity, retention, and growth while lowering costs. In other words, they help businesses either do more with the same amount of employees or do more with fewer employees. Let me rephrase that. Either they help businesses do more with the same amount of employees or do the same amount of work with fewer employees. So they increase the productivity of each employee through technology, through their software, through their automation and artificial intelligence platform technology. Now, the quarterly financial highlights for this company: revenue came in at $2.7 billion, which was up 23% year over year. Their current RPO, which stands for remaining performance obligations that are due within the next 12 months, what will turn into revenue over the next 12 months, increased by 26% to $9.36 billion. And the remaining performance obligations that are non-current increased by 36% to $19.5 billion. So these will eventually turn into revenue, but not over the next 12 months, over the longer term. So this is an indication of what the company's revenue will look like over the next few years. And when a company's remaining performance obligations are increasing by faster rate than revenue, that could indicate that the company's revenue growth rates will accelerate going forward. That wouldn't be the surprise, given that companies are trying to utilize automation and artificial intelligence to streamline operations, save costs, or do more with the same amount of employees. And so companies like ServiceNow are experiencing an increase in demand for those reasons. Now, the company generates good profit margins. Their non-GAAP operating margin increased by 150 basis points to 31%. And their non-GAAP free cash flow margin increased by 800 basis points to 17%. Looking ahead, they are forecasting roughly 22% revenue growth in the fourth quarter with operating margins of 29%, with current RPO growth of around 21.5%. So similar rates of growth at similar profit margins for the fourth quarter for ServiceNow. For the full year, again, the fourth quarter will complete their year, but overall, they're forecasting 23% growth for the year with non-GAAP operating margins of 29.5%, which would be an increase of 200 basis points, and non-GAAP free cash flow margins of 31%, which would be an increase of 50 basis points. Overall, the company forecasting revenue growth over 23%, profit margins increasing, cash flow margins increasing, and remaining performance obligations longer term are also increasing robustly. Everything you'd like to see if you're a ServiceNow stock investor. The company's renewal rate held steady at 98%. It's held at this level for 3 straight quarters and for 4 out of the last 5 quarters. That means existing customers are renewing with ServiceNow at a 98% rate. That's a good number to have only 2% of customers leaving and 98% of customers sticking around. That means you're delivering good customer value. Otherwise, customers wouldn't stick around. They would cancel their service and move on from your services because they feel like they're not getting their money's worth. Following these results, ServiceNow's stock price is down 2.3% in the aftermarket hours. You can see volatility surrounding the earnings release, and you can understand why I typically tell investors when you're approaching earnings season and you're considering buying a stock, it's better just to wait for the earnings to come out, digest the results, and then buy the stock afterwards, because the earnings release creates volatility in a company's stock price and you're taking extra risk. And so in most cases, I advise to buy the stock after the earnings release, or in some cases, when I feel shares are undervalued enough, I advise investors that there's enough margin of safety to go ahead and make your allocation completely before earnings release. In some cases, I say to split your purchase in half, buy half before earnings and buy half after earnings. And that way you reduce your risk on both sides. You reduce the risk of missing out and you reduce the risk of having a big stock price decrease. And it's because of this extra volatility, and it's because of all of the information that's come out that investors don't really have access to digest, that when the company releases earnings, all of that information is now revealed and everyone is on the same playing field in terms of information. Whereas in the week or two before the earnings come out, there's been several other data points that changes the probability of where the company's revenue and profit and cash flow are actually going to be reported. And for most investors, you might not have access to all that data points, or you may not have enough time to digest all of those other data points to come to a conclusion on where the company's profit is going to be. So that way, when you wait, you get the company's earnings results like I just shared with you here. And now you're pretty much on the same footing as everyone else. There hasn't been more data that's come out about what this company's revenue and profit will look like, because this is the freshest data out there and you have the latest information available. So following these results, ServiceNow is trading at a forward price to earnings of 55. It's not a cheap stock, but the company delivers premium results with excellent cash flow margins, excellent profit margins, and north of 20% revenue growth in an industry that's accelerating. So I've liked this company's prospects all year long. I felt like the valuation premium is worth what you're getting in return for the price that you're paying. So I've had the stock rated as a buy all year long. I last updated this as a buy on July 9th, and I'll reiterate my recommendation here in this video, and I'll remind everyone that I still think this ServiceNow stock is an excellent stock to buy, even at current valuations. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.